Think about it. It's a flywheel, right? We pay too much, and that's probably because we don't have enough time to spend looking for great deals. Compounds into cutting corners on renovations, compounds into management challenges, compounds into now we have to spend more time figuring out how to make this deal perform better. And then you don't have enough time to look for deals, and now we're back at the top of the cycle again. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. In this episode, I'm going to be talking about the death spiral that some investors find themselves in after they overpay for a property. Basically, what happens to investors downstream after overpaying for a deal? And we're going to talk about all the challenges that occur when an investor does pay a little bit too much for a property. And the inverse way of thinking about that is, what don't you have to worry about when you buy a good deal, when you pay a below market price for a property? And, even again, another way of thinking about this is, what is the one thing that we can solve? What is the one problem that we can solve that solves multiple other problems? And that's a question we ask ourselves all the time in our business, whether it's related to buying a good deal or it's a hiring challenge or a marketing problem or an operational issue. Usually, if you tear back the layers of the onion far enough, you can get back to one decision or one components of your business or what have you that, if solved, solves a bunch of downstream issues. For example, let's say, and this is a quick example, then we're going to jump into what I'm talking about, the core of this episode. Let's say that you are constantly having tenant issues. You're constantly having high turnover. You're constantly having, or residents are constantly damaging their unit on the way out. You're working through a bunch of evictions, etc. And you're trying to solve for all of these problems. You're trying to maybe solve your tenant selection issues. You're trying to renovate your units at a different level so they're a little bit more hardened and can withstand more damage. You're trying to underwrite differently so that you can account for all of these differences. And next thing you know, you're not able to buy any deals because you're underwriting too conservatively and none of your offers are getting accepted. There's a bunch of different ways that you can solve kind of the symptoms of what the core problem is, which is probably, for example, in this situation, you're just buying properties in the wrong area and you don't have the infrastructure in place to manage those assets. And if you tear back the layers of the onion far enough, if you pull the thread far enough, you realize, okay, we just need to maybe not buy properties in this submarket. We need to go a little bit northeast, southwest, whatever it is, and buy properties in a slightly nicer area, which solves the turnover issue. It solves the damages issue. It solves the eviction issues. It solves the collections issues, etc. Now, this isn't to say that if you don't have the right infrastructure in place, you can't buy properties in rougher areas, because there's thousands and thousands of investors that do that. But for example, in that particular instance, that could be the solution to a much larger problem. So let's talk about what the actual deal-making version of that is. And I see this happen with so many investors, and this is happening with a lot of investors right now. I mean, this is a current events episode in a lot of ways. But what I want to do is share the 5 downstream issues or challenges that investors face when they overpay for a property upfront. So let's start with number 1. Sourcing financing and equity becomes more challenging when you are under contract at the wrong price, at a price that's too high. And that manifests itself in multiple different ways. You probably aren't going to get the leverage that you want to achieve because the fundamental deal isn't good enough. If you're raising capital, you're going to have a harder time raising capital. And the capital that you do raise is probably going to demand more of the deal, whether that's from LPs or active partners. So fundamentally, your economics are already skewed on the deal from a debt and equity standpoint, because you're probably giving more to the investors or giving more to partners, and your financing terms are probably not going to be as competitive as they would be if you secured the property at a better price. So right from the get-go, right from day one of being under contract, you're already facing challenges, right? You're already facing headwinds. Number 2, post-closing, you're probably going to begin cutting corners on renovations unless you're coming in right on budget, which very rarely happens, right? It's not uncommon for renovations to go over budget once you start getting into a project and you realize there's a little bit more than you anticipated. So what happens when you pay too much for a deal? What happens when you paid $150,000 per unit for a property that's worth $140,000? Well, you're probably going to start cutting corners on those renovations. You may be minimizing your scope, and you may be doing less in renos, which therefore has a downstream effect of maybe affecting the rents you can achieve. You may be cutting corners from an electrical, plumbing, more core infrastructure standpoint that compromises the ease of long-term ownership for that specific asset. This happens all the time. This is so common, right? Where let's say an investor, they pay 140 or 150 for a property that's worth 140, to use the example I just used. They want to do cosmetic renovations in the unit. Let's say they go ahead and demo the kitchen, demo the bathroom, and they find a bunch of plumbing challenges behind the walls. Maybe it's a bunch of old cast iron. Maybe it's there's a mixed bag of plumbing materials. We have some PVC, we got some cast iron, we got some copper, whatever it is. And instead of addressing those issues while you have the opportunity to, and while it makes sense to do so because you have the tub surround off the wall, you have the cabinets off the wall, you have the toilet removed and demoed, makes sense to take care of those plumbing issues at that point versus kind of turning a blind eye and saying, we don't want to spend that money, throwing everything back up. And then you realize that you have a leak behind the tub surround. And next thing you know, you're demoing again to get back there. And you're paying twice to do work that you should have paid to just, should have paid once to do. Right. So you start having to make a lot of those types of decisions along the way that compromise the long-term ownership and long-term ease of management of a building, as well as potentially some short-term effects as well. And again, inversely, buying a deal at the right price allows you to do more from a renovation standpoint. It allows you to do those things. Let's say you pay 130 a unit for the property that's worth 140. You have much more room to play with where you can spend another couple grand a unit addressing some of these issues that minimize the likelihood of there being some challenges down the road, that allow you to maybe do those last little bit, kind of itty bitty things on top of the scope that maybe you had originally planned out. You get that, whatever it might be, the tiled shower instead of the tub surround. Maybe you can, throw some subway tile in the kitchen and it makes the kitchen pop just that much more. You can spend another 50, 60, 70 bucks on a vanity that's got a better design, whatever it is. And it further maximizes the long-term value of the property in that maybe you're picking up 10, 15, 25 more dollars a month in rent. You're probably retaining your residents for a little bit longer on average because you have nicer units. You have less maintenance calls because you've done a lot of the things behind the walls that cause those maintenance calls. So you can think about it from both ways, right? And again, we're talking about the downstream negative effects, which is you're forced to cut corners and that exacerbates long-term issues. Number 3, management challenges and operational challenges just become far more pronounced and exacerbated, right? Let's say, again, you've had to cut corners or minimize your scope from a rental standpoint. So now you're leasing for lower rents and you're probably leasing to a lower quality resident. Let's say your operating expenditures, or I should say your operating expenses come in a little bit higher, right? Your insurance is a little bit higher than you originally budgeted. Your water sewer is a little bit higher. Maybe you got some contract services that are a little bit higher. And next thing you know, you're trying to shave expenses to account for some challenges in your underwriting because you paid a little bit too much. So an example of this, let's say you go from cleaning the common areas in your building from every 2 weeks to every 4 weeks. So now you're cutting your cleaning costs in half. One, that's probably not making that big of a difference. And if you feel like you have to do that, you have much larger issues, which are that you paid too much. But the other downstream effect is you're reducing the resident experience. You're lowering the resident experience. They're living in a dirtier building. Right? Let's say you have to go from bi-weekly lawn care to monthly, or insert any contract service, right? Other versions of this. Let's say you skimped on your amenity spend because of the fact that you don't have that much money to spend. A lot of these things compound in nature. A lot of the issues in number 2 from a renovation, cutting corners on your renos, compounds into management challenges. And obviously there's a more minimized risk of that when you're paying the right price for a property. When you're paying a below market value for a property, you can absorb a lot of that variance a little bit more. Number 4, each project, each deal demands far more of your attention, which pulls you away from looking for other deals. Think about it. It's a flywheel, right? We pay too much, and that's probably because we don't have enough time to spend looking for great deals. Compounds into cutting corners on renovations, compounds into management challenges, compounds into now we have to spend more time figuring out how to make this deal perform better. And then you don't have enough time to look for deals, and now we're back at the top of the cycle again. We're back at the top of the circle, right? This is just a revolutions here. If you want to build a scalable real estate business, if you want to build a portfolio, you need to understand that finding deals, finding great deals is one of the really important steps in doing so because it allows you to hire to, whether it's hiring internally, whether it's hiring a management company, whether it's bringing in a partner who's going to be focused on actually operating the deals. And it allows you to actually trust people to operate the assets because you're buying them for the right price and because you don't feel as if you need to step into the trenches to actively solve problems. Now, regardless of how good of the deals you buy, there's going to be challenges. And you should also keep an eye on the properties that you own, and you should make sure that you're asset managing them effectively, you, your partner, whoever. But again, we know the deals we have that go really well and that we don't necessarily need to spend a ton of time thinking about because they're going extremely well and because they don't demand a lot of our attention. Buying more deals that fall under that umbrella is how you build a scalable business. And again, I just ran through the flywheel. I just ran through the circle of the death spiral, right? That's again, I'm going to use that terminology again. And oftentimes these things compound. Number 5, the last one I want to talk about is you fundamentally prolong the length of time that it takes to pull your money out, to execute a capital event, whether that's a profitable sale or whether that's a cash out refinance. For example, when you buy the property that's worth 100 grand a unit and you pay 80 grand a unit, right? I'm using round numbers here. The day of closing, you have an additional 20% in equity because of the fact that you bought it 20% below market value. And we're leaving transactional costs out of this for ease of conversation. Obviously, that does have an impact. But what that allows you to do is, let's say you put 20% down, but you have 40% equity. Well, you can do a refinance at 80% LTV hypothetically and pull your original cash out the day after closing. And this is, again, for ease of conversation. If you're paying full market value, you then need to wait for that property. If you pay 100 grand a unit, for example, for the $100,000 unit property in terms of what it's valued at from a market standpoint, you have to wait until that property gets to 120, 125 unit in value for you to do a cash out refinance to pull out all your equity. So you're fundamentally prolonging the length of time that it takes for you to access that capital again and then recycle it into your business. The bigger spreads that you can that you can achieve, the better deals that you can find as it relates to what you're paying versus what the market value is, the faster you can pull that cash out and the faster you can either A, do the next deal, B, reinvest in the property, C, reinvest in your business, or D, just leave in the bank for reserves and just risk mitigation. And those are all, A, B, C, and D, what I just mentioned there. All of those are options that you want to have. You want to have the freedom to do those various different things and not have no options and not have any of those options because you paid too much for the property. And then what I was just talking about was paying market. Let's say you overpaid. You paid 110 a unit for the property that's worth 100. Now you got to wait for that property to get to 130, 140 in value for you to go in there and pull out your equity. So again, it's just another illustration as to why it's so critical that you're paying the right price for the assets that you buy. So those are the big 5 in terms of the negative downstream effects. I'm going to list one more, just something that I believe as it relates to where you're spending your time in your business and why consistently buying properties for the right price allows you to more specifically allocate your time and more effectively allocate your time, which is in our business. As I was growing the business, I knew that I was a deals guy. I really liked looking for the deals. I liked the marketing. I liked getting active on social media, building the relationships that led to the deals. I knew that was more so of my skill set than operations, which is why when we brought our management in-house, we brought in an operational partner. I have great people to help with that. And that's still something that I spend time focusing on in our business, but it's not my core strength. And I realized that. But what I realized very early on was I need to spend my time finding great deals so that I can afford to hire a third-party management company to manage it, and I can pay that full freight, right? That full third-party management price. I can afford to hire GCs to oversee our renos so that I'm not on site every day, and so that I don't have to be on site every day. And what I quickly realized was that when you buy the properties that are worth 100 grand a unit for 80 grand a unit, you can spend a little bit more on management by hiring a third-party company. You can spend a little bit more on your construction and just you budget for it up front when you're running your numbers. And it demands far less of your time, which is something I've already really talked about as I ran through the 5 downstream effects. But it's a really important thing to consider, right? Because you can do the inverse of this. Let's say you love operations. You're not really a marketing guy. You're the inverse of me. Well, you can pay 100 grand a unit, but let's say you can reno apartments for 10 grand a unit instead of $20,000 a unit, right? And you build your in-house management right off the bat on your like the best in class operator in your market at property management. You have your vacancy periods are half the time the competition is. You're leasing for more, et cetera, et cetera. Your NOI margin is far higher than the competition. Well, you can afford to pay more for properties because you've dedicated all of this time to building that infrastructure. In my opinion, it's far easier to build an effective infrastructure around consistently finding good deals, and it takes less time to do that than it does to build the organization with in-house construction, in-house management, where you're buying materials from directly from supply warehouses, and you're doing all of these different things. You should do that at some point, and there's all kinds of value in doing so. But when you're starting out, it's much easier to just be really good at finding deals. To make a very long story short here. So that was just a little bit of a honorable mention as to why this is obviously so important. But I'm going to quickly recap the 5 downstream effects, talk about why it's a flywheel, and then I'll get you guys out of here. But number 1, day 1 of the contract period, sourcing financing and equity already becomes more challenging. Number 2, you oftentimes find yourself cutting corners on renovation and CapEx, which compounds into challenge number 3, which is you're dealing with management challenges such as you have higher operating expenses, you're leasing for lower rents, you have lengthier vacancy periods, etc., which then compounds into number 4, which is each project demands far more of your attention and you're investing way more time into each individual deal, which then takes you back up to number 1, which is you don't have the time to find the deals. So you're back into the top of the order there. And then number 5 that I wanted to mention, you prolong the length of time it takes to pull your capital out of deal and to recycle it into the next one. So your business fundamentally isn't as scalable. If you learned something in this episode, please consider leaving the podcast a rating and review. Again, just a reminder that last week's episode was number 250. And I think it's going to be very, very important here to remind everyone that you can use code 250 off to buy our 7-day multifamily course or to buy our off-market deals course. 2 programs that have individually over 10 hours of content within each, just like an absurd amount of value for the money. I'm basically giving it away for the amount of blood, sweat, and tears I've put into those programs. Everyone who takes them is extremely happy with what they've spent and the value that they've received. So again, this is a promo that we're doing as we've hit 250 episodes on the podcast. And we're basically cutting the price of both of these almost in half. Well, half of the 7-day course and almost half of the off-market deals course, which we're kind of bringing out of retirement. So if you want to go and buy those, the links are going to be in the show notes. And again, I always ask, if you know someone in your network who you think is going to find some value in this episode, please send this to them. Please consider just sharing this episode with them over text, over email, post it on your socials, what have you. I'll always be forever grateful for everybody who goes out of their way to share the podcast. But again, thank you all for listening. Hope you found some value in this episode, and I'll catch you guys on the next one.